moment while I go live on Facebook. Gonna take just a minute. And we are live on Facebook. Hi everybody, good afternoon. Welcome to tonight's lesson. My name is Sami Abu Saad. I'm Director of Education at T3 Live. Thanks for tuning in. Gonna be doing our regular Tuesday afternoon lessons, and we're going to be covering part 2 to last week's. We started last week with amplifiers. We're just doing a review of the events, the occurrences, the trading combinations that make patterns even more reliable. So last week we covered the top 4, bottoming tail, topping tail, changing the guard, the narrow range body or bar, and above average volume. Today we're going to talk about the other 4 amplifiers. Again, we call them amplifiers. You can call them anything you want. They're basically events or occurrences that make the setup even more compelling and more reliable. Okay, so that's what we're going to cover. But before I get started, as always, a standard required disclaimer to let you know that trading is risky and that whatever we discuss today is for educational purposes only. Also, if you wouldn't mind, if you like and find benefit in today's video, be sure to hit the like button, and beneath the video you'll also find helpful links if you'd like to check them out later. Okay, but for now let's go ahead and get started. So as I said, we covered I'm just giving you a quick review of the 8 amplifiers which I've already covered with you. So last week we talked about the first 4. Today we're gonna just quickly review the bottom 4. Now again, I've covered these in detail in the past, so this is just a quick review. All right. Okay, and this is lesson number 31. All right, so we're talking about things again that make the setup, this pullback pattern, better, right? Make it even better. To show you, we were just discussing this in the coaching session today for strategic day trader members. We're talking about Amrin, how we had 2 plays on it in the room today, one in the morning off the 2-minute chart. And notice it was a buy setup. Here it is, pull back to the rising 20, and then right to target, which was the prior high, the high of the day. And then in the afternoon, it set up again one more time, pull back to the rising 20 and right to target and slightly more, and closed absolutely at the high of the day. So what are the things that make this pattern high quality? There are 10 of them. What you see on the chart here, what you see on the slide is 8. We covered the first 8 last week. Today we're going to cover the bottom. We covered the first 4 last week. We're going to cover the bottom 4 today. So minor support and resistance. First, what is minor support? Minor support is basically support that's found in an uptrend. So when stocks go up, they don't go up in a straight line like this. They go up in a zigzag. So they go up, down, like so, which helps the stock actually continue higher as people get shaken out. If people enter and never exit, at some point all the traders that are interested in playing the stock would have already gotten in, and there would be no more buying. But because people start to doubt that the stock is going to continue higher, they exit, and the selling renews the stock. Does that make sense? It becomes no longer overbought. And then when it comes in, everybody likes to get in everybody likes a deal, a discount. So traders jump back in it. New buyers also jump in. People that are waiting on the sidelines looking for a pullback like we were on the Amrin today, which propels the stock higher. But minor support is the area that was what we would consider resistance. This prior pivot high in an uptrend is resistance because it's an area where the sellers overcome the buyers, and that's why the stock pulled back. So when the stock starts to come in, some people also short it. Okay, so they short it there, and when the stock pops, they don't cover. They don't have stops in the system. These are the novice traders. Their system is called hope and pray. So as the stock goes against them, so let me redraw this. As the stock, so let me just open a new page like this. So as the stock, so here it is, pulls back. As the stock goes against them, now they're in big trouble because it's way up. They shorted here, right? And now they're in big trouble. So they start hoping and praying that it comes back down to break even so they can get out of it at break even. When it comes back down to break even, they start buying it. They start covering it, which helps the stock to move back up. Does that make sense? Now, professional traders like ourselves, some of us, recognize that when a stock pulls back to a prior resistance area in an uptrend, it's an area that you want to go long because there's a lot of people looking to cover, looking to exit there. So by doing so, by going long, we also add fuel to the fire. Does that make sense? So minor support is resistance. Minor support is the resistance area that got broken to the upside, just like the ceiling above you. If you were Spider-Man and you were to go above it to crash through it, you would land on it. So it becomes a floor on a pullback, and that is called minor support. Okay, so minor resistance becomes support on a pullback in an uptrend, and the same cycle repeats. So this is a great area to look to play long. Minor resistance is found in downtrends. It's only found in downtrends. There is no such thing as minor resistance in an uptrend. Okay? So minor resistance exists in a downtrend. The traders that bought it, let me show you. Just need to restart my annotation tool. The traders that bought it here, and when the stock dropped and didn't get out of it, and then here they're, let's just say, they were down 1,000, down 2,000, down 5,000. On the way back up, when they get their break even back, right, they exit, which means they sell their position, which pushes the stock lower. Professional traders who also recognize what's happening, the ones that short in this area, add fuel to the fire, which helps make this area a really significant area of resistance. Okay? So if we get a pullback to minor support, it gets 10 extra points. That buy setup becomes higher quality, becomes more reliable. So that's why this is trading combination number 5, and a pullback to minor support gets 10 extra points. As you can see on the chart, minor support is at or sometimes just above the resistance area. Now, why sometimes we say minor support can be found just above? Because if you're down $5,000 here, you might want to start covering as soon as it gets close to your break even. Like you're down, might be down 200 down here, and you just cover. You'd say, I was down 5, 4, 3, 3,000, 2,000, 1,000, almost break even, $200. The stock starts to pause a little bit. You just say, the heck with it. That's no problem. I can live with that. And so sometimes traders cover before the stock even gets down to the minor support area. That's why minor support exists at or just above resistance in an uptrend that got broken through to the upside. So as you can see, that's minor support. Stock pops again, pulls back to where? Minor support. That resistance area becomes minor support. And then, and the cycle repeats. So that's minor support. Sometimes we can, the stock can base at minor support. That's resistance got broken through, and the stock based at minor support. That is my single favorite breakout play, which is when a stock goes to resistance and bases at resistance. That's my favorite breakout pattern of all time. Okay, that's a breakout at minor support. A sell setup at minor resistance. Got it? A sell setup at minor resistance. What was support becomes resistance once broken through to the downside. So this was a sell setup right here at minor resistance. Okay, that's trading combo number 5. Trading combo number 6 says stocks. We just talked about how stocks never go in a straight line, rarely, and if they do, they collapse. They go climactic, basically. They run out of buyers. They go up and down, up and down. But the question is, how far down is acceptable? How far down, if a bullish stock were to retrace 70%, is it still would it still be a good idea to play it long? And the answer is no, it's not. Usually you want the stock, the bulls, to hold 50% of the initial rally. 50%. But 50% is too precise, so we just say in the 40 to 60% zone, anywhere there is okay. So as long as it pulls back to the 40 to 60% zone, you might say, what about a stock that pulls back just 10%, 20%? Wouldn't that even be stronger and better? Yes and no. No, because yes, it would be stronger, but it would be too close to the prior high. So it could easily fail because it's too close to resistance. The pullback needs to be proportional to the rally. You can't have a $20 run up and then a 50-cent pullback. That's not, it's like running a marathon and resting for 10 minutes and then somebody expecting you to run another marathon after resting for just 10 minutes. You probably need to rest for 10 days. Does that make sense? So the pullback needs to be proportional, but how much is the right area? Well, we say in the 40 to 60% retracement. So if a stock were to go from $36 to rally to 40 and pull back to 38, that's 50%. In the 40 to 60% zone, it gets 10 extra points. Got it? Gets 10 extra points. Likewise, if a stock were to drop from 40 to 36 and rally back up to 38, that area qualifies as the 40 to 60% zone, a bearish zone, in this case for a short. And that sell setup would get 10 extra points. Okay? So here, as you can see, let's say from here to here, that's 100%. From here to here, that's about 50%, 40%. From here to here is 100%. Back to here, that's about 40%. So it gets 10 extra points. From here to here is 100%, and then this pullback is about 40%. So it qualifies as the 40 to 60% zone. Okay, and that's trading combination number 6. From here to here is 100%. Back to the low here, then that's about 50% in the 40 to 60% retracement zone. Gets 10 extra points. Okay. Trading combo number 7 is the rising 20 MA. At T3, we say this is the one. This is probably the single most important trading amplifier. Most useful for sure. Okay. And basically we use a 20 period moving average. I use a simple moving average. You can feel free to use an exponential or a weighted moving average. It doesn't really matter. You just want to be consistent on all time frames. You want to use the same moving average. Since most traders use simple, I like to, and we trade people, we don't trade charts. We're trying to understand how other traders are viewing the stock. I like to use simple as well. So I use the simple moving average, and we say if a stock pulls back to the rising 20 in an uptrend, it gets 10 extra point. Okay? And that's trading combo number 7. And that, as I said, is probably the single most useful trading combination in existence. So notice where the pullback stopped, right at the rising 20. See it? So that gets 10 extra point. Breakout off the rising 20. pullback right to the 20 MA gets 10 extra points. The transitionary buy setup right here, right off the rising 20, gets 10 extra points. The beautiful thing is, this is the key thing, is most of the time when stocks pull back, they pull back, the good pullbacks, they stop at the rising 20. The pullback, if you look at it, is usually in the 40 to 60% zone, and it's at minor support. So these three trading amplifiers go hand in hand, so to speak. They are location amplifiers, and if the stock meets one, it usually meets if the stock has one, it has the other ones too. It gets the point. In this case, it got the point for being at the rising 20, minor support, and the 40 to 60% retracement zone. Does that make sense? So all three amplifiers are usually present. Okay. Here, a couple slides back, we said on many occasions the 40-60% retracement level will coincide with minor support and the rising 20. When this happens, the potential potency and reliability of the play rises. The same is true in reverse for stocks in a downtrend. So these are location amplifiers, and they make the setup really, really potent. Again, notice the pullback right to the rising 20. In this case, slightly above it, but it doesn't have to touch it. I honestly like it when it just touches it, but doesn't have to touch it, anywhere in that area. Okay, anywhere in that area. To the downside, when the stock is downtrending and we have a declining 20, same exact thing. Stock rallies to the declining 20, gets 10 extra points. Declining 20, rally, sell setup, 10 extra points. Okay, this was a picture perfect sell setup. Doesn't really get better than this because we had all the amplifiers. It really had all the amplifiers. We had a T3 sell setup, okay, at the declining 20, at minor resistance, and the 40-60% retracement. You might say, well, how is that 40-60%? From here to here is 100%, from here to here is about 50%, right? 40-60%. With a topping tail, a narrow range bar, and a COG. This was also called this is called a COG at the 3 o'clock reversal time. So it's a 90-point play. 90-point play. Basically picture perfect. Okay? Notice this pullback. This was a transitionary breakout. Stock was transitioning higher. So pulled back right to minor support, right to the rising 20, and the flat 200 MA. When you have the flat 200 and the 20 in the same area, oh, that's a beauty. That makes the setup even more potent, because a lot of people look to buy stocks on pullbacks to the 20, and other traders look to buy at the 200. So you have both groups buying in the same area. Okay? A famous Chinese proverb says a picture is worth 1,000 words. In this case, it was probably worth $1,000. The 20 and the 200 and this chart show why they command huge respect in all time frames. And that's what I have on my charts. The 20, blue line, and the 200, the red line. Okay? So we talked about minor support, which exists only in uptrends. Minor resistance exists in downtrends. Major support and major resistance exists mostly in sideways bases. Okay? Sideways bases. What's major support? Major support is basically the bottom of the base. But in order for us to consider a stock to be in a sideways trend, it would have to have at least one double bottom. Okay? At least basically 2 prior pivots. If you have 2 prior pivots, then you can start to buy it in the same area. Then you can buy it on every time after that. And that's considered major support. In this case, major support is a price level or area that at which demand for a stock overwhelms the existing supply. It's an area at which the buying, which was light, begins to overwhelm the selling. This offers a unique buying opportunity. The key thing to remember here is that major support can be defined as a current low revisiting a prior low, not a low revisiting a prior high. Minor support is defined as a low that revisits a prior high. In this case, major support is a low, a pivot low, revisiting a prior pivot low. Okay? The major resistance is the complete opposite. It's an area of pain, and when traders get their money back, they look to exit, and you have the shorts that recognize what happened there, and they want to get rewarded too. They short, which pulls the stock down. So major resistance is when you have a sideways base and the stock retests the top of the base. So you short it at the top of the base, not when it actually breaks slightly under the base. That's not where you short it. So if you have a sideways base, you want to buy the bottom and short the top. And that's trading combo number 8. Okay? That's trading combo number 8. So if you have a buy setup at major support, it gets 10 extra points. If you have a sell setup at major resistance, it gets 10 extra points. Here's a base. As you can see, it doesn't have to be at the exact number, exact price. It's the area. So that's the top of the base. That's the bottom of the base. You want to look to play at the long at the bottom and short at the top. Eventually, every sideways base breaks out or down. So one of these times you might short it here and then find out that, you get stopped out. You were wrong. That's fine, because you were right once, twice. This should have been circled 3 times, 4 times, 5 times, 6 times. So does that make sense? So eventually every sideways base breaks out or down. But you can short the top and buy the bottom. As we said, the first couple of pivots are not playable. Actually, you could have played it right here too. Every other time after that is playable. Short. First 2 pivots, not playable. Every other pivot is playable. And eventually it broke out. Got it? So that's buying at major support. Sometimes 1 prior pivot low is enough. I said we needed 2. Sometimes 1 is enough if the prior pivot low was a climactic buy setup. We haven't talked about climactics. It's when the stock accelerates to the downside and runs out of sellers, and then rallies really hard and then retests it. 1 pivot is enough. Or if it happens after a significant move up, the stock rallied $10 here. It doubled basically. Because when that happens, a lot of people notice that stock. And so when it pulls back to that area, they say, whoa, last time it was at $10, it rallied to 20. Let me buy it. It's back at 10. Which makes it a high odds area to play long. Now, of course, I'm just giving you the area here, but you need to know how to do it. It's not just, if you bought it here, for example, you'd have gotten stopped out. So you have to know how to do it also. So there's more to it than what I'm just covering here. If this second pivot is also solidified by flat 200, a rising 20, something additional, then that would be also considered major support, even though there was only 1 pivot. Got it? So as you can see, major support is a retest of a prior resistance, prior support area, okay? And mostly exists in sideways trends. Minor support is a retest of a prior resistance area that was broken through to the upside. On a pullback becomes support, just like the ceiling becomes the floor if you were able to crash through it. Okay? The reason why major support even exists is because rewarded traders, positive memory caused by many traders being handsomely rewarded traders always look to repeat their actions on the next go around, right? They look to buy again. So it exists due to a self-fulfilling prophecy, basically. Major resistance exists due to also negative memory, where traders got hurt. When they get their money back, they exit, and that pushes the stock lower. You have also professional traders that recognize what's happening and they short it, which also adds fuel to the fire. But I was going to say that major support exists because due to a self-fulfilling prophecy. Minor support exists not due to a self-fulfilling prophecy. Minor support exists due to what? Due to what? What's the main reason why what's the main driver behind minor support? It exists because everybody, myself included, likes it when we get our break even back. So if you're in a stock and you're down a lot and you get your break even back, what do? You cover. So minor support exists because traders always look to cover if they were in a short after getting their break even point back. So it exists due to trap traders wanting to get out at their break even point. So it exists due to pain, basically. Being in pain and then finally getting relief is a huge thing. And traders again cover. Their covering propels the stock higher. Okay? You have also professional traders that recognize what's happening and know that this is a high odds area to play long, and then they go long, which exasperates the situation. Major support, on the other hand, does not exist due to traders being trapped. It exists because traders got rewarded. Rewarded traders look to repeat their actions. So it is said that minor support is actually a stronger support area than major support for that main reason, which is minor support exists due to traders being trapped and then getting their break even back, whereas major support exists only because rewarded traders look to repeat their actions. But if they're not around, they're not going to repeat their actions. Or if they don't want to, then they don't have to buy it. At minor support, pretty much everybody has to buy it. That's in it and trapped. Everybody has to buy it. The other reason that we say minor support is actually stronger than major support is because minor support exists in uptrends. Only exists when you have an uptrend. If you don't have an uptrend, you don't have minor support. Because minor support, we said, is it pulled back to what was resistance becomes support. So as you can see, I know I just went off the page here. As you can see, minor support exists only if the stock is in an uptrend. Major support mainly exists in sideways trends. Stocks that are in an uptrend are stronger than stocks that are in sideways trends. And therefore, as I said, minor support is considered to be actually stronger than major support, despite the names being a little bit backwards. Minor doesn't actually mean like minor as in insignificant. It's just the name that was given to that support area. Okay. Question from Hari in the room here is 2:50 p.m. The buy setup that I called in the room on Amrin, was there minor support? Yes, but I'd have to look at it on multiple time frames. Anytime you have a stock attempting to roll over a little bit and then goes higher, you got trapped traders here. So when it pulled back here to that area, then it was at minor support, but not a very clean area of minor support. Looking at the 5-minute chart, you want me to look at the 5. So at 250, so 250 that's 250, right? That's exactly right. See how the pivot failed, popped, and then gave us a pullback right to the top of the pivot. So you're absolutely right. That was at minor support on the 5-minute chart. You're absolutely right. Okay, very good. Good observation. All right, well, that was basically a review of the 8 amplifiers between today's lesson and last week's lesson. That was just a quick review of the 8 amplifiers that make setups even better. I hope you're enjoying these lessons, and if you are, feel free to check out the Strategic Day Trader. Link is in the description. You can join me for the next 30 days for just $49. Almost free. Almost free. Okay? If you are not a day trader, that's for day trading. If you are a swing trader and want to join me in the Strategic Swing Trader newsletter, the same thing. $49 for just for the first 30 days, and then it goes up after that to $95 a month. But if you don't like it, for some strange reason, let's say it's not for you, feel free to also cancel, and you would only be charged only $49. So it's almost free. We just want to encourage traders to check out the room. because we are confident that once you're in it, once you check it out, give it the first 30 days, that you won't even leave. That's why the price is really low for the first 30 days. Okay? So I trust you will click on the links and check them out. And with that said, I want to say have a great evening, and thank you again for being here. If you have any questions, be sure to reach out to our customer service team, info@t3live.com. info@t3live.com. Have a good night and good trading, everybody.